World Bank has raised its forecast for Kenya's economic growth by 40 basis points to 4.9%, citing a combination of low inflation and lower policy rates. Now, resilience in the agriculture sector is expected to add to that benign growth story too. But that said, the World Bank points out that there are key uncertainties to worry about. For one, it is unclear how competitive Kenya's exports will be following the expiry of the U.S. AGOA agreement, while domestic efforts to lower the fiscal deficit may also act as a brake on growth. The East African nation's economy is still assessed as being at high risk of debt distress. Meanwhile, on the policy front, the World Bank argued for a range of changes designed to enhance Kenya's ability to create the jobs that the country desperately needs. Back in 2013, the private sector created 106,200 new jobs, while in 2024, that figure fell to 45,100 new jobs. And that is despite several years of GDP growth of around 5%. The bank argues that wide-ranging reforms are needed among state-owned enterprises to not just restore market discipline, but also to cut the costs to taxpayers. Now, in the fiscal year ending in June 2024, the state spent about $9 billion supporting state-owned enterprises. That's about 1.3 times what the country spent on foreign and domestic interest in that period. Well, CGTN's Ramanyang spoke earlier with Ryan Kuo, who is an economist at the World Bank in the Finance Competitiveness and Innovation Global Practice. And Kuo began by exploring the argument for reducing the amount of cash that the Kenyan state spends supporting state-owned enterprises such as Kenya Airways and Kenya Railways.
The argument that the report is making is not necessarily to get rid of all of this support, but rather for the government to put itself in a position so that it can make these decisions on a more informed, coming from a more informed perspective. Because, as you rightly point out, there's trade-offs on the one hand behind the desire to promote national champions, and countries have reasons for wanting to do that, as well as then the end outcomes for consumers in terms of pricing or service quality. So, as the report highlights, the key here is going to be robustly analyzing, even quantifying those trade-offs when that's possible, so that the government can make a clear-eyed decision based on its national interests and objectives.
Because I'm sure that when you put these arguments to the government, they'd have said, well, we don't want to be left in a situation where our access to the outside world by air is then determined by foreign entities that we do not control. Because we've seen that happening in some markets. In Africa, Nigeria, for example, if you have a carrier that says, well, we're not flying to your country, sorry, that is a problem. That's a concern that the government probably would have.
Absolutely. So like I said, I think it's about weighing the impacts on markets and all of the good things that they bring in terms of prices and services against some of these other national objectives that may or may not be commercial in nature.
There's an argument that you also make here for infrastructure sharing regulations and imposing remedies, especially in the telecommunication sector, imposing remedies after studies that identify mobile service providers that may be either dominant or have a significant market presence as well. By not implementing these recommendations, effectively the status quo at the moment, what is the opportunity cost that the Kenyan consumer is carrying?
I think, not to beat a dead horse here, but again, the key here is going to be careful analysis and finding fit-for-purpose solutions. So what the report highlights is that before any requirements related to dominance or significant market power are imposed, what's required is going to be an up-to-date and robust market study. Now, if that market study finds that there are competition concerns that require addressing within the market, then it's about finding a fit-for-purpose solution in terms of finding where that market power is being exercised and finding the appropriate remedy. So just to give an example of some measures that have been adopted in other countries following their market studies. So again, this is not saying that this is what Kenya should adopt, but rather just examples from other countries. So one thing that some countries have enacted after doing these market studies is caps on what we call, or regulations to prevent large network operators with large subscriber bases from charging exorbitant interconnection fees, that is the cost to connect calls from out of network,
upon the MTR rates, as they're called.
Exactly, upon their smaller competitors. And what these measures do then is that allows the smaller competitors to compete on the basis of their prices and their service quality rather than simply the size of their subscriber base. And on the whole, when we have competition on those grounds, rather than just simple subscriber base, that's how you get lower prices, better services, and ultimately more growth in jobs.
Because, looking through the report, the thing that sticks out to me is the fact that a lot of the recommendations that are being made are, in most cases, pretty straightforward and things that we've been discussing in the past. Sugar sector reforms, for example, lowering the tariffs that we have on sugar coming in from COMESA states, for example, in order to avoid the current situation where we're locking the Kenyan consumer into buying a lot more expensive sugar from the domestic market. But the problem that always comes up is the fact that we effectively asking the same government that has a commercial economic interest, right, in these companies, but he's also the one that is making the rules, to somehow decide that, well, you've got to sort of separate those two out and have an arm's length relationship, right, between the regulatory function and the SOEs that these governments essentially own, isn't there? That's the heart of the problem.
Absolutely. So SOE governance is a big part of this equation. The other part of this equation we think is, look, sometimes governments have very valid reasons that they own SOEs and very valid reasons that they want those SOEs to engage in activities that may or may not be profitable, just out of public interest.
Or markets that may be natural monopolies, like pipelines, for example.
Exactly. And so the key here then is to have these robust governance structures so that the commercial parts of these businesses are still responding to commercial incentives and competing in the market fairly. And that when you do have some support for these, let's say, less commercial operations, that support is ring-fenced. And when you ring-fence that kind of support, that brings you two benefits. Number one, you make sure that every dollar of exchequer funding that is going towards these public service objectives is actually being spent on those public service objectives. And secondly, from a market perspective, it makes it so that those SOEs, for their commercial operations, are playing on a level playing field vis-a-vis private competitors.